This is Ron Sneller, registered financial consultant and investment advisor representative with your 5 minute market watch. Today is the 2021 second quarter market outlook brought to you by Retirement Wealth Advisors and Brookstone Capital Management. Now, we'll start by talking about the fiscal stimulus. The new stimulus package announced in March makes it an estimated $5.2 trillion in U.S. fiscal response to the COVID-19 pandemic. Now, to put that in perspective, the pandemic had only about a quarter of the loss of cumulative GDP than that of the global financial crisis, but has actually received more than 4 times the fiscal spending to support economic activity. Now, U.S. fiscal spending in both absolute and relative terms have been larger than most other countries. With this massive spending, the United States is estimated to show its strongest contribution to global growth in 20 years. Now, as far as inflation goes, the market has reacted to the stimulus efforts with a heightened anticipation of higher inflation. Now, interest rates moved higher in line with higher than expected economic growth and inflation. Now, as a reminder, bond prices decline when interest rates rise. So treasuries had their worst quarter in 40 years. But to put that fact into perspective, really, the bond market is just reversing from the panic low yields from last year. Now, transitioning over to stocks, the market has shifted from favoring growth to value stocks. And these rotations have occurred rather abruptly. And given growth's large outperformance last year, in the first quarter of 2021, value showed its best relative quarterly performance in 20 years. Now, the valuation dispersion between stocks ended last year at its widest dispersion in 20 years. So the market has moved in a manner to narrow that dispersion. And while tech stocks led last year and some areas became extended, in general, it was not nearly as dramatic as the late 90s tech bubble. And while the public market saw tech stocks cool off, the private equity market continues to aggressively invest in tech. So, as we noted in the 2021 outlook at the beginning of the year, we could see many trends reverse. And that's exactly what's played out in the first quarter of 2021. The implication is that diversification for today's world takes a little more effort. Now, the fundamental elements of diversification still apply. It's prudent to own a combination of assets in line with the investor's risk profile. Now, from a practical perspective, while stocks get all the headlines, a portfolio that owns a combination of stocks and bonds reduces the time from peak to recovery, and at times that could be managed in years, or excuse me, that could be measured in years. Now, bonds are not all the same. And like stocks, they have a variety of different sectors that respond differently to different interest rate environments. So, incorporating a more thoughtful bond strategy makes sense in today's environment. Now, 2020 saw a rise in thematic strategies or strategies that focus on opportunities, such as disruptive innovation. Now, these strategies allow investors to allocate to unique opportunities that are generally not represented in traditional portfolios. This has been the second quarter 2021 market outlook.